Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Fortive is a precision measurement and industrial software company spun off from Danaher in 2016. Its portfolio centers on the Fluke test and measurement brand, Tektronix oscilloscopes, and a growing suite of industrial workflow software.
The Danaher lineage is key context. Fortive inherited the Danaher business system, continuous improvement, lean manufacturing, and disciplined capital allocation. That operating DNA shapes how Fortive manages every business in its portfolio.
Revenue divides across three segments: Intelligent Operating Solutions at 42%, covering Fluke, Tektronix, and workflow software; Precision Technologies at 33%, and Advanced Healthcare Solutions at 25%.
Fluke is the crown jewel brand. Industrial technicians and electricians specify Fluke test instruments by name. Brand loyalty, unusual in hardware markets. Workers refuse to switch to cheaper alternatives, giving Fluke consistent pricing power.
Tektronix occupies a similarly dominant position in oscilloscopes, instruments that visualize and analyze electrical signals. Tektronix has been the reference standard for electronics engineers and university labs globally for decades.
The software layer is a strategic priority. ServiceMax provides field service management software to industrial and healthcare companies. Once scheduling, dispatch, and compliance run through ServiceMax, switching costs become very high.
Operating margins run around 20%, and free cash flow conversion consistently exceeds 90% of net income. The software segment contributes recurring revenue that improves the quality and predictability of Fortive's earnings mix.
CEO Jim Lico has led Fortive since the 2016 spin-off, with 2 decades at Danaher before that. He drove the Vontier spin-off in 2020 and the ongoing pivot toward higher-value software platforms.
Competitively, Fortive's peers include Ametek, IDEX, Danaher itself, and Roper Technologies, all industrial technology compounders that combine niche hardware leadership with recurring software revenue and disciplined acquisition strategies.
Fortive has raised its dividend for 8 consecutive years since the spin-off. The yield is modest at 0.6%, consistent with the preference for retaining capital to fund acquisitions and organic investment rather than maximizing payout.
The acquisition pipeline remains active. Fortive targets niche industrial technology and software businesses where its operating system can drive improvement. The framework mirrors what Danaher pioneered: identify, acquire, and improve.
Products and services reach over 100 countries. Fluke instruments are used by over 7 million professionals globally. That installed base creates a recurring service and replacement parts revenue stream that supplements equipment sales.
The long-term trajectory is a gradual increase in software recurring revenue. Hardware provides the stable platform, software enhances margins, improves retention, and reduces the cyclicality traditional industrial instrument companies face.
From the tool in an electrician's belt to software managing hospital equipment compliance, Fortive connects precision measurement and operational workflow in ways that deepen customer relationships across industrial and healthcare sectors.
That's the company chapter for Fortive. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Fortive just delivered an earnings beat and the stock dropped almost 5%. Q1 2026, revenue up 7.7% to $1.07 billion, adjusted EPS of 70 cents, a 9% surprise. So why is the consensus 0 buys, 6 holds, and 3 sells? That's the most bearish read in our entire batch. This is Charged Alpha. Let's break it down.
Fortive is an industrial technology platform spun out of Danaher in 2016. After the June 2025 Ralliant separation, which spun off Tektronix, Cetra, and the Precision Technologies portfolio, Fortive is now a leaner, software and healthcare-focused company. 2 segments: Intelligent Operating Solutions, the Fluke instruments, Gordian Service Channel and Accruent SaaS bundle, and Advanced Healthcare Solutions, which handles sterilization, water testing, and clinical workflow software.
The investment story changed materially with the spin-off. Pre-Ralliant, Fortive was a diversified industrial conglomerate riding the Danaher business system playbook. Post-spin, it's a tighter portfolio with higher recurring revenue mix and gross margins around 61%. New CEO Olumide Soroye took over in June 2025 with a mandate to prove the leaner Fortive can compound earnings without leaning on the test and measurement cash cow it just gave away.
Q1 revenue from continuing operations was $1.07 billion, up 7.7% year-over-year. Core organic growth was 5.3%. Adjusted EBITDA grew 13.2% to $314 million, a meaningful acceleration over the top line and exactly what bulls want from a software mix shift story. Adjusted diluted EPS came in at 70 cents, up 25.4% year-over-year, ahead of the 64-cent consensus.
Segment breakdown. Intelligent Operating Solutions revenue grew 5.3% organically, driven by the Fluke Instruments business and continued SaaS expansion at Gordian and ServiceChannel. Advanced Healthcare Solutions grew 3.2% organically, slower but with structural tailwinds in sterilization volumes and clinical workflow software. The takeaway, both segments are growing, but neither is growing fast. 5% on the bigger segment is fine. It's not a re-rating event.
Margins tell a more complicated story. Adjusted gross margin came in at 61%, down roughly 100 basis points year-over-year at the consolidated level. At Intelligent Operating Solutions specifically, gross margin compressed about 150 basis points. The culprit is tariffs. Input costs rising faster than Fortive can pass through pricing or implement countermeasures. Management framed this as transitory, but the bearish analysts disagree.
Cash flow is the bright spot. Free cash flow trailing 12 months is $978 million. Cash on the balance sheet is $376 million against $3 billion in debt, net debt of $2.8 billion. Leverage is manageable, and Fortive returned roughly $500 million to shareholders via buybacks in Q1 alone, retiring about 3% of float.
Operating margin held at 17.7% and net margin at 11.3%. Return on equity is 8.4%, respectable for industrials but well below the Danaher and Roper benchmarks the bulls anchor to. Forward EPS guidance for full year 2026 was reaffirmed at $2.90 to $3, with management indicating performance is trending toward the upper half of that range.
One number worth circling, the trailing PE of 36.8. That's a premium multiple for a business growing core revenue at 5%. Forward PE drops to about 19 times on the guided EPS, which sounds reasonable, but the gap between trailing and forward depends entirely on Fortive hitting the guide while absorbing tariffs. That execution risk is exactly what the sell side is flagging.
Now let's address the elephant. The analyst consensus on Fortive is 0 buys, 6 holds, and 3 sells. In our entire 29-ticker charged alpha batch this quarter, this is the single most bearish setup we've covered. No analyst has a buy rating. The average price target sits around $62.50, barely above the current $60.23 share price. The street is essentially flat to negative on this name.
Why? 3 reasons keep showing up in the research notes. First, the post-Ralliant Fortive is unproven. The spin-off was only 10 months ago. Analysts want to see at least 4 quarters of clean, comparable numbers before assigning premium multiples. Until then, the conservative call is hold. Second, the tariff drag is hitting margins right now, and visibility on countermeasure timing is genuinely murky.
Third, and this is the core sell thesis, Fortive's growth math doesn't pencil out at 36 times trailing earnings. 5% core revenue growth, even with healthy operating leverage, implies high single-digit to low double-digit EPS growth over time. That's a roughly 20 times forward business, not a 35 times trailing one. The sells are saying the multiple needs to compress before the stock works.
There's also a structural concern. Fortive's growth historically came from acquisitions executed through the Danaher business system discipline. Post-spin, with a new CEO and a smaller portfolio, the question is whether the deal pipeline that drove the past decade still produces. If Fortive can't acquire its way into faster growth, The organic 5% becomes the ceiling, and that ceiling doesn't justify the current multiple.
What would change the rating? Bulls would need to see core organic growth accelerate above 7%, gross margins recover the 100 basis points lost to tariffs, and at least one accretive software acquisition under the new CEO. None of those are visible in the Q1 print, which is why the stock dropped nearly 5% on what was technically a beat.
The bull case starts with the software mix shift. Gordian, Service Channel, Accruent, and Fluke Reliability are SaaS businesses with high gross margins and recurring revenue. As they scale within the iOS segment, the blended gross margin should rise structurally. 61% today, with a path towards 63 to 65% if software outgrows hardware over the next 3 years.
Second, Advanced Healthcare Solutions is a quietly defensive growth franchise. Sterilization, water testing, and clinical workflow software grow with hospital procedure volumes and regulatory mandates. 3.2% organic growth this quarter understates the long-term durability. These are non-cyclical, mission-critical product lines.
Third, the Danaher business system hasn't disappeared. The operational discipline that built 13% EBITDA growth on 5% revenue growth this quarter is the same playbook that compounded shareholder value at the parent for decades. If new CEO Soroy executes, the leaner Fortive should produce cleaner, higher quality earnings than the pre-spin version.
The bear case is the simplest of any name in our batch: valuation versus growth. 36 times trailing earnings on a business growing core revenue at 5% doesn't work without flawless execution. Industrial peers growing at similar rates trade in the 18 to 22 times forward range. Fortive at 19 times forward looks fair only if you trust the guide, and the sells don't.
The tariff drag may be more than transitory. Even if Fortive implements countermeasures by mid-year, input cost volatility is higher today than during the Danaher era compounding decade. 100 basis points of gross margin compression in a single quarter signals pricing power has limits.
Post-spin Fortive is a different, less diversified company. The Precision Technologies segment that just left as Ralliant was the highest quality test and measurement franchise in the industrial world. Tektronix, Fluke Calibration, etc. What's left is a software and healthcare bundle that has yet to prove it can compound at premium rates without that anchor.
Finally, the acquisition risk under a new CEO is real. Soroy took the chair in June 2025. His track record at Fortive is short, and his first major capital allocation decision will set the tone. A bad deal, overpaying for a SaaS asset to chase growth, could compress returns on capital quickly. The market is reserving judgment, which is exactly what the consensus reflects.
Fortive's most relevant peers are Danaher, Ametek, Roper Technologies, and Idexx Laboratories. Danaher is the parent company and cultural anchor, same Danaher business system DNA, but at a much larger scale with higher organic growth and a richer healthcare and life sciences mix. Danaher trades at a premium multiple that Fortive aspires to but currently cannot justify.
Ametek is the closest functional comp. Both companies are diversified industrial technology compounders, growing core revenue at mid-single digits with disciplined acquisition strategies. Ametek trades at a similar multiple to Fortive, but with a longer post-spin track record and a more consistent earnings cadence. Ametek is essentially what Fortive is trying to become over the next 5 years.
Roper Technologies is the software pure version of the playbook. Roper has fully transitioned into vertical market software at premium multiples, and Fortive's bull case implicitly anchors there. The gap is that Roper's software revenue mix is north of 70%. Fortive's is much lower. Until that mix shifts dramatically, the Roper multiple is aspirational.
Idexx Laboratories rounds out the comp set as a healthcare instruments peer. Idexx commands a premium multiple because it grows organically at high single digits with very high gross margins and a strong recurring consumable stream. Fortive's Advanced Healthcare Solutions segment is a smaller, slower analog. The model is right, the scale and growth rate aren't there yet.
Options activity into the Q1 print was defensively positioned. Implied volatility was muted relative to historical earnings cycles, reflecting the post-spin uncertainty more than directional conviction. Put-call ratio sat near 1.1, slightly skewed to puts, consistent with the bearish analyst consensus and the cautious institutional positioning ahead of the report.
Post-earnings, the stock dropped almost 5% in pre-market despite the EPS beat, which compressed implied volatility further. Traders who bought protective puts ahead of the print captured value. Traders who sold premium, expecting a typical beat and rally pattern, got hurt. Fortive is one of those rare names where good news on the headline doesn't translate to a positive stock move.
Longer-dated open interest is concentrated at the 60 and 65 strikes for January 2027, bracketing the current price tightly. That structure suggests institutional traders see Fortive as range-bound until the tariff and post-spin transition stories resolve. Limited conviction in either direction, which mirrors the analyst consensus almost exactly.
On insider activity, the picture is unremarkable. CEO Soroye is still relatively new in the seat, and most insider transactions are scheduled 10b5-1 sales tied to equity compensation. No notable insider buying, which would be a meaningful confidence signal during a sentiment trough like this one. The absence of insider accumulation matches the cautious external view.
Bottom line on Fortive. Q1 numbers are fine, but valuation does the heavy lifting against the sell case. 0 buys and 3 sells means the burden of proof is on management to prove the leaner portfolio works.
If you own it, hold for the SaaS mix shift and watch Q2 margins. New buyers should wait for the multiple to compress or organic growth to accelerate. Charged Alpha rates this a hold with a bearish lean, outstanding heritage, unfinished thesis, expensive entry.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street